Impact investment provides wings to the social sector to address the world's most pressing challenges in sectors such as sustainable agriculture, renewable energy, conservation, microfinance, and education. With the intention to generate positive social and environmental impact, the impact investment market is steadily growing and has sized up to a market worth USD 715 billion. Today's panel will focus on evidences and experiences on impact investing for social sector funding. To moderate this panel, I would like to invite Mr. Karthik Desai, Executive Director at Asha Impact. Asha Impact is an impact investing and policy advocacy platform which runs a capital on call virtual fund for Indian business leaders, UHNIs, and philanthropists to invest in scalable, for-profit social enterprises. Asha Impact also works with the Indian government on sector-specific advocacy based on the experience of its investees and building the market for blended instruments like impact bonds through its non-profit trust. Great to have you, Mr. Desai. Up next, we have Mr. Arindam Datta, Executive Director and Head of Rural and Development Banking and Advisory at Rabo India Securities. Mr. Datta has been working with Rabobank for the last 14 years and has over 28 years of experience in rural finance, cooperative, microfinance, and agribusiness banking. Mr. Datta is responsible for the sustainability banking initiatives on knowledge, risk management, and business development. He also oversees the Rabo Foundation projects in blended finance, technology, and innovation. Lovely to have you, Mr. Datta. Up next, we have Ms. Akanksha Sharma, Global Head, Social Impact and Sustainability for Sterlite Technologies. Ms. Sharma is a globally acclaimed international development and public policy specialist, carrying an eclectic global experience spread across 4 continents. She has many titles to her name, like the 100 most influential social impact leaders globally and Asia's top sustainability leader. Ms. Sharma has 13 plus years of diverse experience in leadership roles at both large corporations and UN agencies. Lovely to have you, Ms. Sharma. Up next, we have Mr. Shantanu Ghosh, CEO at Social Finance India. Mr. Ghosh, based in Gurgaon, is currently the CEO of Social Finance, which is a non-for-profit consulting intermediary focused on designing long-term outcome-oriented, pay-for-success developmental programs, syndicating appropriate blended finance for those programs, and then proving effective governance for all stakeholders. After 30 years in the corporate world, Mr. Ghosh made the shift to the social sector to contribute back to society. Lovely to be hosting you, Mr. Ghosh. And our final speaker for this panel is Mr. Karan Raj Chaudhary, Advisor, India and South Asia, SDG and Innovative Finance at UNDP. Mr. Chaudhary focuses on supporting stakeholders, developing blended finance solutions, and forging strategic partnerships to direct investment capital in pursuit of improved social and developmental outcomes. At UNDP, he supports a number of country offices and initiatives, including impact venture funds in Indonesia, affordable housing schemes in Bangladesh, and early stage accelerators in Sri Lanka. Lovely to be hosting you, Mr. Chaudhary. I would just once again like to remind all our panelists that this session runs till 4:30 p.m. Please reserve some time towards the end for a short Q&A with our audience. Over to you, Mr. Desai.
Wonderful. Thank you very much. And we're just going to jump straight in, given the time constraint. Welcome to all of the esteemed panelists, Shantanu, Arindam, Karan, and Akanksha. The agenda that we have in front of us today, as part of this convening that's happening on CSR, is basically the role of impact investing and how does it relate to CSR. So won't go into too much detail on what is impact investing, but just to set a very brief 30-second context, the definition of impact investing that I think most of us use is to basically profitably deliver goods and services to underserved populations, right? So it's using a market-based approach to deliver basic goods and services. And often, though not always, impact investing has been market-based investing. So it's basically venture capital, but in sectors like education, healthcare, agri, and so on, and serving the base of the pyramid or the middle of the pyramid. However, there's also a segment of impact investing or investing which is muted returns investing, which is investing in companies which make slightly lesser returns. And that's what we call blended finance or impact bonds. So that's also a segment. And of course, the preponderance of investing has generally been in the equity form for a variety of reasons, structural in India. but debt is equally important. So there's also that notion of equity versus debt, right? So that's the very brief context that impact investing is an industry that's been around for a decade or so. It's growing, it's overlapping with commercial capital. And the crux of it is that it's a small industry. The data that's put out by the Impact Investors Council and ourselves in an industry report showcases that over the last decade, the total impact investing that happened in our entire country was about $11 billion with a B, right? So that's roughly $1 to $2 billion a year. Obviously, it's been growing in about 600 or so enterprises over the decade. So that's the summary of it. So obviously, it's not a very large sum of money. So CSR money is, well, it's certainly more than $1 billion per year. And then philanthropic money is even more. So this question has always been there, that how does corporate social responsibility, how does corporate money, converge with this? Now, of course, legally, CSR money has to go into not-for-profits. And there are these, specified activities into which it can go. So over the last 3-4 years, there's been a lot of advocacy efforts on this, whether CSR money can go into startups directly, whether it can go into incubation. And now, specifically in impact investing, there is openness to using CSR money for this. So this would, make it interesting for all of you in the audience. So I'll stop there with the context. And we've got a fantastic panel with us today. I think the introductions have already been done. So if it's okay, what we could probably do is go through each of the panelists so that they can share their perspectives on this issue specific to, the organization that they represent. And then we can do a couple of rounds of Q&A and of course, audience Q&A. So if that's okay, we'll get started with Akanksha. Akanksha, Sterlite is obviously a very, very well-recognized company and, one of the leaders in the technology space. And you guys have also been pioneers in CSR. So to kick us off, could you help us get a perspective on how CSR and impact investing go hand in hand, and how do you really look at this space? How should corporates be looking at impact investing? And what are the different ways that CSR can be used in a creative manner? What are some of the things that you guys have done? Maybe we can get started with that.
Thank you, Karthik. And thanks everyone for having me here. So just to set the context right, I would just pick up a data point from the latest SDG report, which says that India stands at 117th position currently on the SDG parameters. And, together, both the private and the public sector in 1920 could invest only about $1 billion USD for the Indian development. It clearly shows that we have, because what is India at a better pedestrian to, and which talks about the need for impact investment as a tool and, as a very important instrument here. How I see the CSR space also is, I think all the companies, irrespective of their size and the quantum of money that they have in their CSR kitties, is always having some sort of limitation. And I think impact investment gives us that opportunity and opens more options for blended finance and through various instruments that can amplify the impact, and you can actually create much more scalable solutions with quantifiable outcomes. So I think when we look at projects which are mostly overlapping in the CSR ecosystem that you see, everybody is doing it tech. Most of the companies are now shifting to digital telemedicine or the healthcare programs and stuff like that. I think there is a larger need that how can a more collaborative model be built in through innovative finance models like impact financing, and where public sector can also put in money to create a larger exponential impact. So this is how I see this as a great opportunity. I'm looking forward to hear more and answer the questions.
Sure. Thank you, Akanksha. Taking it next to Karan, wanted to set the context on the ecosystem, and then we'll dive into the two practitioner perspectives. So Karan, and just to set the context to those in the panel and the audience who may not be aware of this, the United Nations Development Program, UNDP, of course, is an entity that I'm sure everyone is familiar with. But the amount of work that they've been doing in the social impact space to build standards, norms, and the marketplace for this is quite substantial. They've been doing a lot of work both with investors and with policymakers. They have something called the Sustainable Finance Collaborative with the Department of Economic Affairs and the Ministry of Finance. And they've also been developing standards for these impact bonds in alignment with the United Nations' own Sustainable Development Goals, the SDG impact bond standards, and really trying to address a lot of these key bottlenecks in building the market for impact investment and particularly blended finance. And of course, they've been leading some of the advocacy work on the CSR law itself. So Karan, with that introduction, could you give us a lay of the land and to the audience, to CSR practitioners and people who manage CSR budgets? How should they really be looking at what's happening in the impact space? Where is the ecosystem at? And what are some of the key regulatory issues, and where do things stand?
Sure. Thanks, Karthik, and great to be with all of you this afternoon. I think from my perspective, there are probably 5 areas that come to mind in terms of bottlenecks or areas that really specifically need attention when it comes to catalyzing this space on impact investing. The first is, just when we talk about blended finance in India, we've been talking about this term for years. It's been around forever. We pride ourselves on saying that, it is about how philanthropic capital can really come in and de-lever and de-risk for commercial capital and so on, and really catalyze financing in the process. But for all of that talk of blended financing in India, really the amount of blending that's taking place is very limited. There is just not as much taking place. A lot of it has to do with regulatory inhibitors as to the process that I'm sure Arindam and others will talk about that prevent the mixing of different forms of capital, whether it's philanthropic and charitable funds with return-seeking capital. So that in itself is an area that requires more attention. In fact, we are working on a paper now which should be out hopefully in the next few weeks, together with the World Bank, Nishit Desai and others, that specifically just like is a few initial thoughts on some of these barriers and what is it that needs to take place in terms of legislation. Because a lot of these issues are not to do with changing the law per se, but in many cases to do with just providing a clarification. So is something, because something is not explicitly not permitted, but it isn't permitted either. So where does the law really stand? No one wants to get into this sort of a blended finance transaction and then need to justify it for years at an end to tax authorities or other regulators. So that is certainly one area. The other is, one of the instruments that you referenced, Karthik, around Pay for Success, and Shantanu is, of course, the master who will talk about it just now. But in Pay for Success, we realized, again, and this was in fact together with Social Finance, USAID, yourselves at Asha Impact last year, that outcome funding in India, which is typically when you pay not for the cost of the inputs, but rather as results are achieved, and which are pre-agreed and predetermined, that outcome funding in India is extremely limited. So we do need to unlock new pools of capital that could potentially fill that gap. And CSR has huge potential for that space. It is, as you said, at the very least $1.5 billion of capital each year, and a pool of capital that will grow with time as the economy grows. So the use of CSR as outcome payments is a terrific way forward in this space, and it still needs more support in terms of, again, clarifications and explicit permissions from the Ministry of Corporate Affairs and so on to be able to take that forward. And we did a bit of work on that last year, and I think there's still some way to go. And I think I'll just stop with one more and not cover everything in this question, is just around standards. When we talk about impact investing, there continues to be divergence on, how do we measure impact? What are the right set of standards? What is acceptable to investors here in India? What is acceptable globally? Our view on this has been that really we need to ensure that the SDGs as a mechanism are fully ingrained in the impact measurement and management process for enterprises. While we are coming out, and we have in fact just last week published the SDG standards for enterprises, that is sort of our effort to mainstream the SDGs, not just as a CSR activity, but as part of core business operations of entities. And I know that SDGs are also being incorporated in a number of other IMM frameworks as well. So I'll just stop there, Karthik, and hand back to you.
Thanks, Karan. I think you've really flagged a couple of key issues which we'll come back to, something for all the panelists to think about. One is, what exactly are those regulatory ambiguities and clarifications that one is seeking? And then this core issue of impact measurement, and not just in the technical way we think about it as impact investors with applying it to our SME investments, but impact link accounts and impact weighted accounts. There's so much noise happening on this, in the Bloomberg Financial Week or whatever that happened in New York this week. The Schroeder CEO made a huge pitch for this, saying that all companies have to start now giving impact linked accounts, and P&G had a board resolution kicked out by shareholders where the products were not sustainable. So I think what we're seeing is that this impact talk that we all talk about is not just restricted to SMEs and NGOs, but really is becoming part of corporate thinking. And that's kind of where impact investing is going, which is why this is such a welcome and valuable discussion. So those people who are working in CSR functions in corporates, you guys are really at that intersection of corporate, money and corporate decision-making and this impactful world. So it's extremely significant. And now coming to Arindam and then Shantanu, of course, Arindam, there's so much amazing work that you and your institution have been doing in financial enablement, specifically in agriculture. And I think what's kind of, and of course, agriculture is a deeply impactful, emotive, relevant issue, both from a farmer's income and farmer's dignity perspective. And of course, we all know what's happening in the news, and from a national security, if I can put it that way, food security, national welfare perspective. There's so many issues there. So you work on that issue and financial enablement, and it's backed by banks in many cases. And you're focusing on debt access, right? And some of the issues that Karan had mentioned about, the mingling of funds and how to bring money in. Could you give us a bit of a lay of the land? Because I think what you guys have done in Agri is very cutting edge. It may be very useful for people to just even understand what all things you guys are doing. And what do you see as the key challenges currently, and where CSR money or CSR, thinking can be helpful?
Thanks, Karthik. Thanks, Karthik, for defining impact finance and blended finance. And thanks, Karan, for the wonderful presentation you gave on the regulatory challenges. So, Karthik, what we do now, before I give my presentation, two things. One is a lot of work is going on in India and in the other emerging economies, work done by the social sector, by the government or organizations like the World Bank, ADB, on building up enterprises, collectives, or in strengthening the education health system. Now, one of the key constraints across sectors is unless you have access to finance, most of these initiatives, enterprises, business are not going to take off in spite of all the hand-holding that you do. So access to finance is a necessary condition for economic development. Second is, if we talk about the SDG 17, that's extremely critical. Collaboration across sectors, I'm talking about the public sector, the private sector, and the development sector, is critical. It's not easy. I'll give you a couple of examples. It's not easy, but till that happens, and that's where blended kind of instruments kick in, it's going to be a challenge to achieve the other 16 SDGs. So what is it that we do? About 6-7 years back, I mean, the discussion we are having now, we had the discussion internally as to how we could create blended finance solutions for access to finance to the underserved segment within the F&A, food and agribusiness supply chain, smallholder farmers and their collectives. At that time, it was a struggle to get the right kind of legal compliance structure in place in India because of the reasons that Karan mentioned. So what we did was we mobilized funding, non-commercial funding offshore. We contributed, and there were other organizations which contributed, and we issued a guarantee to Indian financial institution, one institution, to be able to provide debt financing to a farmer cooperative. It was an organic cotton, cooperative. Now, since then, the learning has been huge. That was the starting point for us, and since then, we have been running 14 blended finance instruments for farmer producer organizations, for AgTech, for AgFinTech, all to ensure access to finance for smallholder farmers. And each one of them is unique. And we have about 14 financial institutions in India, which includes NBFCs, mainstream regulated banks, and the so-called impact funds who are fronting all these transactions. So what we do is we syndicate non-commercial capital offshore, and we issue a guarantee through Rabobank to these financial institutions for a well-defined end use. I'll just give you two examples. One is the first of its kind climate smart agriculture guarantee program that we are running. So what we did was we provided a first loss, and USAID, they provided a pari passu guarantee to 2 Indian financial institutions. And even that was a struggle because of actually understanding the demand at the ground level. What is quasi-bankable? So it was a 10-year program. So the financial institutions could take long calls because climate programs, as you mentioned, the returns, they take their own time. But estimating the demand was a huge issue because there are so many organizations working on the demand side, but they didn't have the experience or the expertise on financial and business, aspects. And when we did a deep due diligence, we found that most of them were not really bankable. They were just social structures which were set up. A second was very few financial institutions were willing to fund the transaction because they found it to be too complicated. There was a lot of reporting requirements. So we have set this up. It's running in the Indian market. That's one example. The second example is, there are 14 such. I don't have the time to cover all. The last one we are working on, we are going to launch it next month. It's a COVID response fund for agri-transition, which has 4 end use, which includes food loss, clean energy to the agriculture sector, the FPOs and technology, which is near the farmers. So what we did, we syndicated a first loss again offshore. We got global, most of them European foundations to pull in a first loss. And we got DFC, that's the Development Finance Corporation. That's the guarantee arm of the government of US to front a transaction. So it's a $55 million, it's not small, program which is going to be fronted by 3 NBFCs. These are impact funds in India. These are the kind of transactions we do. So in the last one that I mentioned, when we talk of SDG 17, there's collaboration between the foundations, which is the development sector, the commercial sector, which are the 3 Indian NBFCs, and the government, which is the US government, all getting together. Not easy. The devil is always in the details. And second is collaboration between and across continents, North America, Europe, and India, in trying to solve our access to finance problem. So we have a host of these guarantees running. Now, as Karan mentioned, it's very, very difficult. We still don't know how to do it within the country to mingle non-commercial and commercial money. So we do it abroad, and we run guarantee programs in the Indian market, which is fronted by financial institutions. And as you mentioned, for the financial institutions, it's a de-risking tool, and they are able to scale up their operations and funding to an underserved segment. I'll stop here for the time. Thanks.
Wonderful. No, thank you for that. I think, as you said, these guarantee structures actually help catalyze significant amount of capital because of the the underlying underwriting that you're doing, because these projects have to be bankable, and then the complexity and risk appetite of the investors. And I think, as you said, that the crux of this is collaboration, SDG 17. We also
And let me add one point. Sorry, Karthik.
Yeah,
The
please.
leverage that the development sector gets with every $1 of money they put in. If they put in for TA, it's just at $1. But in our case, we get leverage of anything between 3 times to 70 times. That's the kind of, private capital that we can unlock through these blended finance solutions.
Correct. And the second point is, and it's replicable. And this is a nice, pivot to Shantanu. And brief introduction, Shantanu is the head of Social Finance India. They're an entity which has been doing amazing work globally in the US and UK and other developed markets, and now are doing this in India. And I think they already have a bond out there which is using CSR capital, the one in Haryana. And like how you guys are, Rabo has been doing in agriculture, social finance, I think, is focusing extensively on the area of skilling and livelihoods and working closely with NSDC. And the same principle, Shantanu, if you can talk about, right, of how do you use some bit of development capital or outcome funding capital, which you guys have been able to mobilize from pretty blue chip names like Tara Trust and NSDC and others, to then mobilize risk capital from folks like Asha Impact or any HNIs. So could you just sort of lay out your thesis on this space and then specifically the role of CSR, of course, which is what the audience is interested in?
Sure, no, happy to, Karthik, and thanks for teeing that up. Glad to be here. So let me maybe make the point on 2 different dimensions. The first point is Akanksha teed up this whole thing about the finance gap with SDG goals and the requirements of finance. Now, if you think of how the gap will get covered, there are 3 levels to cover any gap. One is, obviously the development sector has to put in more money, but there's obviously a limitation to that. The other is to use it as leverage to get more money from the commercial sector, which is what Arindam talked about. And the third is also to get far more return effectiveness from that money in terms of impact. And what I'll try and do is to divide this conversation into 2 parts. One is the leverage part of the conversation, and one is the impact part of the conversation. Now, if you look at CSRs, and CSR Box recently came out with a report on the CSR of the 260 or 270 odd companies, which probably would be about 60% of CSR in India. That's about 11,000 or 12,000 crores of CSR. Now, the striking figure there is that 11,000 or 12,000 crore has gone to 4,500 projects. Okay, so that effectively works out to about a 2.5 crore per project in the year. And if you reflect back and think about therefore, how do CSRs approach this? Now, there are 3 types, right? There are some really large CSRs, large groups of companies which have their own foundations, which have their own long-term programs. And maybe, half of them do a very good job in really driving impact at scale and create multiplier effect of that impact. So that's about 25%, so that's about 12.5% of the overall CSR money. But the balance 87.5% essentially is 2 things, which is a lot of these interesting experiments and investments. I mean, we had Bajaj Electrical talk about fascinating work that they're doing in Himachal Pradesh with solar panels. But they are all small scale and relatively small scale, which also bears out with that number of per project kind of spend, right? And the other is that they do a lot of capability support to the sector through the volunteering and through the people. So my ex-company, Genpact, does huge amount of that through their fellowship programs and stuff like that. Now, where the opportunity lies is for people like us who come in as intermediaries and try and co-create larger programs, which are outcome focused and which has payment correlated to levels of outcomes achieved, is to really find ways to galvanize that 87.5% of CSR money into much larger, much higher impactful programs together with collaboration, right? And I'll give you the example of Haryana. The Haryana bond that Karthik referred to is an early education experiment, grades 1 to 3, 120,000 odd kids over a 3-year period, and basically focused at learning outcomes, not how many kids complete the classes and all, whether they become grade ready as at end of grade 3. And we all know that in India, at end of grade 3, we have a serious problem of how many such students are actually able to do the reading and the writing, which is equivalent to grade 3. So that's actually trying to solve for that. It's in Haryana. And the interesting thing of that, so that's about a 20 crore program, 3 years commitment two funders, one anchor funder, one smaller funder, both CSR, guaranteed by a foundation in terms of the results. So if the results are not achieved as per the targets, then the cost per beneficiary and the outlay will become lower in a correlated manner. Now, that's one part. So that's a scale, that's long-term, outcome-focused, pay for success. But I think the more important part is that this program started last year, and obviously then COVID happened. And this program is essentially driven at in-school teacher intervention. So now the entire program has had to be redrafted and redone in terms of the nature of the intervention. And what has happened is, because the funders are committed, because the guarantor is committed, because the evaluator is committed, because the delivery agency is committed, because we as a convening agency are committed. So the 6 of us are iterating to make it work so that at least these students have some level of intervention even during this period. And we are still not going away from the grade level competency that is being looked at. And I think that's really an opportunity in how we think about it. And we have a couple of other such programs coming up, each of them 40 crores, 4 years kind of model, where two, three funders coming together along with a couple of agencies and stuff really creates long-term sustainable program. And the Haryana program, even those other programs, even after 4 years, it doesn't mean that that whole thing goes off, because it creates capability in the system. And I think that's where the return on investment becomes much higher. On the leverage side, I think the point which Karthik alluded to, what we are trying to do on the skill side with NSDC is really use philanthropic capital to create a leverage for getting commercial capital in to serve people who will otherwise not get financed, just because their risk portfolio is not done. Very similar to what Arindam is doing, even larger scale in the agricultural sector. And I think the reason why we haven't got CSR in the first phase introduced there is exactly the reason what Karan said, because some of the rules and regulations, including some of the clarifications which will help, create some challenges. But I'm absolutely convinced that as we prove a success on the first round of that, there is absolutely no reason why in similar kind of programs we cannot have CSR money play a very significant role, and therefore get a leverage of 10 to 1 on every rupee that CSR puts into the sector.
Fantastic. Thanks, Shantanu, and all. I think this has been extremely useful, and I would love to do another round. We've got about 15 minutes, so we'll try to keep it as punchy as possible. Akanksha, based on what you just heard, right? These different perspectives on what's possible. How does STL look at it? You guys have been a pioneer in CSR. We are co-investors in some impact enterprises. So one model is to take equity investments in such and such startup. What are you guys looking to do? How are you looking at deploying your CSR funds? Would you like to fund impact bonds? How are you guys thinking about your strategy?
So purely talking from my experience, Karthik, here, there are a couple of models which are running. So one is where we are trying to develop first of its kind water community program, along with the World Bank Group, and it's an impact bond along with the Maharashtra state government. And so that's where I said that, when we create a collaborative model like Impact Fund, the role of the government becomes very important, because we have also tried to evaluate few other options on the health bonds and EdTech. And we realized that not many implementing organizations are comfortable in paying interest. And that is where, they want either it to be offsetted, or the government or the state government or some other party to bear it on their behalf, and then, try to work it out. So I think this trend on pay for success model, and I would really agree with what Shantanu said, is trying to, get absorbed in the Indian social ecosystem. And I think we are just at the very preliminary stage on that part. But yeah, just to answer your question, so we are creating a very interesting EdTech program along with AIF, again, an impact fund, where, we, as out of our CSR, we become the guarantor first and then assume the role of outcome funder. So I think that's another proposition we are looking at. But like how Karan mentioned, that the law and the legal integrities really become a limiting factor, because we lack clarifications, and like many other companies, we are trying to struggle on that part. And having said that, I think the role of the government becomes very important here, because if they become a party to it in terms of the guarantor, or say, in becoming a sort of partner in some way, I think, a lot of risk is in some way mitigated. And I think that gives a lot of comfort to many of the partners who are trying to constitute this fund and create a scalable model in few other districts. So these are the two programs we are currently working with, in addition to a lot of direct funding to many foundations, because we have our own foundation and we are working a lot on gender, environment, edtech, and health, leveraging technology. But I personally feel that, we have many interesting tech options and innovations available. There are various models, but unless, many parties come together as an outcome funder, because that is again one challenge we realize, that, not many companies are trying to join the band of an outcome funder. And, out of my experience, and others can be different, of course.
And can I ask one follow-up question? It's something asked by on the panel by this lady Shilpa Narayan. Is there a geographic scope to it? Because when you look at these larger strategic projects like what Shantanu and Arindam are describing, does it necessarily have to be for you or any other company in the same areas where your plants and your operations are, or not necessarily? If it's a Maharashtra-wide project, it could be in all the districts of Maharashtra. Or do corporates still have this thing that the project must be in such and such, which is okay if that's the case because your business is there. Is that constraint actually there?
Generally, businesses have this priority in terms of geographic mapping centered around their operations. But I think, outcome funding, like the way it is, it can be in any part, and it can fund a particular program to make it much more scalable. But I think we need to really evolve onto that part as an ecosystem.
Got it. No, thank you for that, and thank you for your leadership in the CSR space. We hope more and more corporates follow this path. And let's talk now about the regulatory gaps. Just briefly, Karan, I know there's a lot of them, and I think all of us are really keen to look at the analysis that you and Nishit Bhai and that report that you mentioned. But could you give us at least a couple of examples of, for those people who are trying to understand? Because some people say that, look, it's all regulation, the markets are stuck. Other people say that, look, the markets can get around that. It's more of a risk thing. If outcome funding is available, risk capital and outcome funders can contract it out. And as you said many times, these are like vaguish clarificatory things, not structural incentive things which go into the budget. So, I know it's a difficult question, but if you were to highlight maybe one or two examples to let the audience get a sense of what the reg issues are, what would those be? That the ones which one is trying to resolve immediately and the most urgent ones.
So I think, there's so many issues, Karthik, but I think one is also starting out with just an issue of harmonization across various acts or various laws, right? So when we look at the income tax law, when you look at FCRA, when you look at AIF, when you look at CSR, GST, there is a certain areas there which kind of lack harmonization. So I would say that is one. Then there are also issues around, when we talk about things like pay for success and so on, that if services are provided provided by or to a domestic charity, what is the GST implication? Can they be sort of zero rated? Can they become exempt as far as GST is concerned? Obviously, there are also now, as far as pay for success is concerned, there's been a certain tightening around FCRA. And while we in the report doesn't go into that because we think, there's also sort of national security implications and others there. There is, even on that, if, given that the goal of blended finance transactions is to achieve both development and commercial objectives, there may be certain ways in which relaxations with scrutiny could be considered there to encourage more transactions, right? So that is one. And then, when we look at alternative investment funds or social venture funds, how can we allow for regulations that enable direct payments to unit holders using funds received by social venture funds from any source? Because that is kind of, again, very important to be able to scale some of these pay for success mechanisms, right? So currently, if in a social venture fund, if outcome payers are paying into it, or if grant funding is going into it, proceeds can't be distributed to the holders of the AIF. So that again is like a typical example of a key bottleneck that prevents scaling of some of these great pilots that Shantanu and social finance are undertaking. undertaking. So I'll just pause there.
Great. No, thanks for that. To take the kind of the closing question to both Arindam and Shantanu, which is where do we see this market evolving? Given all of these challenges and these tricky issues, which I think have been nicely articulated here, whether it's regulation, whether it's impact, and whether it's unlocking the leverage of the capital. So given a combination of all of these issues, Arindam, first to you, there's one of the questions, the specific questions around, maybe you spoke a lot about the leverage point and all these amazing guarantee structures and, one layer of capital getting another layer of capital, and that's market-based stuff. But do you want to share as to where do you see things progressing? Because agri is such an important space and it's getting so much attention. And, one of the questions there has asked, how do FPOs and agri startups get support? So what do you see as the way forward for CSR and for this tri-sector collaboration?
Yeah, so Karthik, thanks for that question. Now, a lot is already going on in the market. A lot of opportunities are now getting explored. Things which had not been done earlier are now getting done. Now, let me give one perspective which is not always given. See, in India, and it's true for many parts of the world, the private sector, the government, and the development sector, which includes all the NGOs and all, they find it extremely difficult to communicate to each other. I mean, that's a problem I'm sure, Karthik, you would also be facing in the work that you do. I think at the corporate level, there needs to be a lot more exchange of personnel from one sector to another sector. Classic example is Shantanu. I mean, he's come from a hardcore, professional commercial sector, and now he's got into the development sector, and the impact he's going to make is huge. So I think we need to be able to do that so that at least we can sit across the table and make a conversation and speak to each other. That's extremely, extremely important. Second, I would say at the project level, the tremendous amount of so-called CSR work that's going on in our country, a lot of funding, about $2 billion of funding is available. Again, I say a lot of enterprise building, whether you call them farmer producer organization, farmer producer companies, collectives in any form or manner, or individual, entrepreneurs or the micro enterprises. It's extremely important ab initio to have the access to finance piece ingrained in those projects and programs. What happens is these structures are built of collectives, or people are trained, and NGOs are very good at training and awareness building and all that. But then they build up a structure, and then not a single financial institution is willing to take a view on them because they say, these 10 things are not there. And it becomes too late because that structure has been said to be able to, you have to go back to the basic and start all over again. So it's extremely important for all the CSR work being done in India to be able to get financial experts, banking experts in whenever they are building up enterprises of any sort, whether in the agri sector, non-farm sector, it doesn't matter. It's extremely, extremely important because from a bank risk management perspective, compliance perspective, legal perspective, even if the intention is there, the capital is available, blended finance solutions are available, there are constraints at the ground level which prohibits financing to go because these businesses have not been structured to be able to attract debt funding. It's extremely important to get that piece right.
Fantastic. Yeah, absolutely. So exactly the people and the capacity side of it, which NGOs are good at, and collaboration needs to happen, and the capital side of it. You need high quality teams, but you don't want to build something up and it doesn't have access to capital. And I guess that explains a lot of the subscale challenges. That's so useful. And Shantanu, last word to you. Two things. And I'm trying to also, build in the questions that have been asked. So one question is that last one, which is, how do we choose the impact? How do we choose the NGO? As someone, as Arindam said, like yourself, coming from the corporate sector or coming from the markets, that's exactly what people look for. That a more professional, objective, market-based underwriting, if I can use that word. It's not just about capital leverage. There's such and such project and get such and such. It's because it's the right way to do that project and it's the right provider. So how do you guys, think about that in terms of choosing the providers? And then one quick point on the financial side, which is the returns point that Akanksha said, right? That someone has to pay that return. Do you see people being wary to do that? And should CSR pay that return and government pay the principal?
Yeah, and I think there are two parts to this. Look, I think if you think of delivering agencies in the ground, now India has again a classic dual problem. There are just too many, and there are just too few who are scalable. Right. Yeah. And frankly, through a bunch of the initiatives that is happening right now, I actually feel there's going to be a lot of creative disruption, and we are going to gravitate. Not all for good, but inevitably we are going to gravitate to much more consolidation there, which allows for real capability and competency to be built and driven. And if you look at, Kartik, this, there's a lot of progressive foundations, especially of people who have come in from the other sectors, who have actually started doing fundamentally capability building grants. They're not even, project grants, they're just capability building grants and all. And I see that as a very, very positive move. And I think it will get more consolidation. I think from coming back to the CSR perspective, I think we need to look at CSR on two lenses. One is that companies will have a very high incentive to work in their nearby area, in the proximity. And regardless of what size of that project is and what is the real outcome of that project, it's a very high return on branding and on goodwill. And for companies, that's very, very relevant, and they should do that. But they also need to think about the balance pool, which really needs to get into consolidation, collaboration, and syndication. And I think we're just at the very start of that, and some of the examples that is happening, maybe not with CSR Capital, some of the fledgling experiments that we are trying to do, Arundham is doing, and a whole bunch of other people are doing, we need to start pushing that. And these are the forums which also need to start pushing that, including other platforms, the United Way platform, the CAF platform, the Centums of the world. I think that's a move that needs to happen. And that will fundamentally change the amount of capital that is there for building scalable, impact-based models.
Yeah.
But it never will be 100%, and it shouldn't be, because there's a reason why corporates need the goodwill to be built, and this is a very good way to build goodwill, and they should, absolutely, for their local immediate purposes.
Exactly, and it's not just about the local benefit, as you said, but many corporates have a strategic view, right? It's also, it helps build their brand. And it's not just the brand, it's genuine corporate intent. Many of them say we want to do, like you mentioned the example of Genpact. Genpact is famous for its business, but also for doing some amazing things. Credit Suisse, where my other boss works, Vikram, they used to have bankers without borders. So they used to take their associates and send them to work with microfinance companies and so forth. So, you really help define certain areas. Just a crazy example of Mr. Tata is known for helping dogs or something, right? So you can take an area and really that segment. Thank you all so much for a crisp and hopefully a discussion that was useful for the audience. I certainly enjoyed it. And just a quick plug I wanted to make for Asha is that if there are CSR managers here who are interested in social impact bonds, do approach us, because we are looking at building the market for this as well, and are looking at this. And there's several instruments and transactions which are in the market. Many people don't realize that. They think there's only 2 or 3, but this market is at an inflection point. CSR capital is very, very welcome, particularly and especially as outcome funding, because without that, you don't have blended finance. So we hope that this was a useful discussion for everyone and give you a bit of a perspective on, how impact investors are thinking about CSR capital. Thank you.
Wonderful.
Thanks, Kartik.
Thank you.